Okay, so today we are doing investment and portfolio. Don't mind the heading here. But we are going to do return risks and return analysis for single investment. Okay. There's it. Now at the end of the day, I'll be expecting you to understand the meaning and the need for risk and return analysis, understand the meaning of returns, understand the meaning and the type of risk. You should be able to calculate risk and return of a single investment. So that's our objective for today, okay? But before then, I've sent you a video, right? I've sent you I've directed you to a video that you're supposed to go and watch, and I believe by now you know the meaning of investment, and the investment being what committing money into an asset, expecting what a return in the future. Okay, so that is it. I believe you've learned how to manage investment. Okay, I believe under it we have active investor, we have passive investor, we have adversary investor, and we also have financial instrument, which is stated there. I believe you've read about characteristics of investors. That investor can be an institution or an individual. We also know investor can be a risk lover, risk neutral person, or risk uh, average. Okay, so you should know about this. Okay, we have also learned about some factors people consider when they are choosing investment, and I believe one of them was utility score. Okay, we also talked about you probably learned about mean variance, and as of now, you know the mean of mean. The mean is used to measure returns, and variance is used to measure risk. Okay, so these are some of the things. Okay, we did financial institutions was there how they help with investment because people invest. Like if you invest in stock market, we Abena, Abena. Okay, so that's it. So now we are moving straight to risk and return analysis. And like I said, investment is the current commitment of money into an asset, expecting what returns. Okay, now we are going to do analyzing risk and return. Now, one of the way to determine that an investment is good is for you to be able to analyze the possible returns or the possible risks you will be facing. Okay. Now, return is what? The amount you are going to earn on the investment you made. So if you invested an amount and the amount invested, then at the end of the day, what you received, okay? So the amount you received minus the amount you invested is what we term as what returns. Now, mean is used to measure return. And if you go back to, if you've done quantitative before, if you've done business math before, if you've done SS maths, if that then you understand mean. Mean simply mean average, okay? Average of return. And variance, it just talk about how with the returns here varies around the mean, okay, the average. Okay. So examples of investment, we have investing in shares, okay. So examples of returns, sorry, dividends and capital gains for what? Investing in shares. So when you invest in shares, you are going to get dividend and capital gains. So that is the return you're going to get. Then when you invest in bond, you are going to get coupon rate, okay, coupon rate. So that is the returns you are going to get if you invest in what? In bonds. So one of example of bond is treasury bill, okay, where we have the treasury bill rate, okay. Treasury bill is a short-term bond, okay. So that is it. Now let's go to risk. Risk is unfavorable conditions surrounding an investment. That's simply the possibility that you will not get your returns, or you not even get your money invested, or you will get part. The possibility that you might lose the expectation that for which you entered into what the investment. That is it. And variance is what we use to what measure risk. Okay. Now let's come to types of risk. Okay. The two major type of risks we have under investment is system risk. Okay, when I say systemic, I say market risk. They are risks that affect investment based on what market condition or the condition in the economy. Okay, so let's say inflation. You can't do anything about inflation. You can't do anything about interest rate. Okay, if your investment is international, then you can't do anything about exchange rate risk. Okay, so these are risks that is very it affect the economy and it's very difficult for you to control. Okay, you have no control over it. It's affecting every investment. Okay, so you can't control it. Now we come to unsystematic risk. Unsystematic risk here is talking about risk that you can control. You can control by diversifying, and maybe you understand diversification later. That is if you don't understand now. Diversify as in investing in more than one asset. Okay, that is spreading your risk. Okay, now systematic risk, they are risks associated with specific investment. Meaning that if you didn't invest in that particular asset, you wouldn't have gotten that risk. You wouldn't have faced that risk. Meaning that's why we say diversifiable risk. This risk meaning that if you had put all your money in that particular asset or that particular investment, okay, and the risk had happened, then you would have suffered. You would have lost everything. Okay, but if you spread it to maybe 3, 4, 5, then when something happened to one, then you will lose just a small portion. Sometimes even the returns on the others will compensate for the one you lost in one of them. Okay, so that's it. There's another risk that we call systemic risk. Okay, systemic risk is a form of risk that when it's okay, it affects a whole system. Example is financial crisis that happened in 2007, 2008. Okay, it affect the whole system. Okay, in the globe. Okay, let's look at something like COVID-19. It's a pandemic. It's a rate that it occurred and affected everything. Okay, so any rate that when it occurs, it can affect others, meaning because it's interconnected. It's called systemic risk. It's not, I've not read, but I've explained it. Now let's go to basis for selecting investment asset. Okay, we say utility score. Utility score is the satisfaction you get in an investment. Sometimes we invest in them not because the returns are very motivating. We just get some satisfaction when you are investing. Sometimes people come to me to advise them on investment, and the first question I ask is, "What's your goal? What's your goal?" Most of them don't get it. Okay, they'll be like, "What do you mean by what's my goal and all that?" But then, if you are someone who has my number and I ask you to call, I will ask you series of questions and then I'll be able to answer. Now there are some people too that will come with their goal. Madam, I want to invest this my money. I will need it at this time. Which investment will you recommend for me? The moment you've given me time, I have to give you an investment that is very what? Liquid. Or that you can get your money at the end of what? The period. Okay. So this person has the money. But as at this time, what will give him satisfaction is what he can get the return within 3 months or within 6 months. And I'm not going to recommend shares for you because share there's no guarantee. The fact that you go that you want to sell doesn't mean you can get it then. Because I don't even know when you put in the requirement that you want to give it. If someone is interested, they should give it out and give you money. You don't even know when. And when you place it, you don't know when someone will be interested in the shares and what will invest. You can what disinvest in it and get your money back. Okay, so satisfaction. Some people investing in a particular thing give them some level of satisfaction. They are not earning much, but they are happy that they are investing in it. So that is it. That is utility score. Then we have mean variance criterion. As I'm explaining, I've told you that mean is used to measure what returns. And I've also told you that variance is used to measure risk. Okay, so this person is comparing the returns and the risk associated with the investment. So if it's the person is a risk averse person like me, then this person is probably going to want to go for an investment with lesser risk. Okay, so that is it. Now we want to go for me. I would like to go for lesser risk. Okay, but then this lesser risk thing, it doesn't go just like that. Now, sometimes you should be ready to take risk if the return you are getting is very compensatory. Okay, because risk takers, when they hit, They really hit good. Okay. So that is it. Then we have minimum variance investment. This person is just interested in going for the investment with the least risk. Okay, so with that, I can probably recommend treasury bill for you. Okay, because even now treasury bond in Ghana is Ghana treasury bond is some way as at now, because we have not been recovered from the challenges we have faced. Okay, so maybe treasury bill, that's what I'll tell you. Now let's come to investment analysis. When we talk about investment analysis, what you're talking about, you assessing what a particular investment to see and to know the return there is, and also to know whether it's suitable for a particular investor or is suitable for you, the investor. If you are the one investing, is it suitable for you? Okay, like I said, some have high return, low risk, but still it's not suitable for the investor. So we ask the question, what is your goal? What actually do you want? Then we understand before we know we can recommend and assess the investment. We can use that to assess the investment and know which one to recommend for you. Reasons for investment analysis. Now, investment analysis first, it helps you to make informed decision. Okay, informed investment decision. Now, you cannot just go and do try your luck. Let me invest in this one, Sam. Let me invest in this one, Sam. Let me invest in this one, Sam. No. You have to assess that investment. Then you know what you are putting your money in. So at the end of the day, you maximize or optimize your returns. You are sure that there is a high tendency that my returns or my expectations will be met. Okay, so that is it. Risk management. Now, when you assess an investment, every investment has risk associated with it. So when you are able to assess a particular investment, then you'll be able to, let's say, oh, let me adopt this strategy to minimize my risk. And there's a lot of strategies, whether you will insure, whether you will hedge, okay, whatever you do to minimize your risk, then that is it. The return optimization. Now you're able to choose the investment with the highest return. Okay, so it helps. And then the last one, it gives you peace of mind. We work hard to make money. Okay, we work hard to make money. So if your money is somewhere that you are not sure of, you can't sleep. It becomes difficult for you to sleep. You'll be thinking about the money here and there. Okay, so but there are some investment that your money is, or maybe my money is in it because of the assessment I did before investing there. I'm not that worried. Okay, I'm not thinking about it. Okay, I have a peace of mind. Okay, so that is it. Now, let's go to, we are going to do the calculation of single investment very soon. Today, what I'm teaching is very short, but the next topic after this, I can't teach it online. It's very complicated, actually. So we'll just do this. Maybe I will start with the introduction of the other one, then maybe when we meet, we do the calculation aspect, okay? So assumption for calculating risk and return. Now, in finance, actually, we normally have assumption that guide our calculations because we normally have assumption, because if we don't assume that, we have assumption that this is that. If not, we cannot. In fact, a formula will not fit a room. Okay, if you have to take everything into consideration. So these are some of the assumptions. We have investors are risk averse. So meanwhile, we have investors who are risk averse. We have investors who are risk neutral. But we have limited it to investors are risk averse. Okay, so that at the end of the day, we know the conclusion to make. Investment return follow a normal distribution. This, like I said, it's not always true. That one is not here. Okay. It's not always true because there are some investments that are skewed. Okay. They are not normally distributed. They are skewed, actually. So let's move on. Single investment analysis. Single investment analysis. So now this involve what? When you say single investment, means we are investing in one asset. Okay, so we are putting all our money in one basket. Now we have two main data for calculating risk and return of us. Risk and return. We have historical data and we have probability data. Okay, we have historical data and we have probability data. So let's say we are using historical data. Historical data is past information, past data about a particular investment or a particular asset or a particular firm you want to invest in. So this is the question. They say the rate of return for SYZ Limited for the past 5 years was, this one should have been where? So 10%, 20%, 15%, -5%, 7% for year 1, 2, 3, 4, and 5, respectively. Calculate the rate of return and risk. Okay. So this is the formula, sigma of return. You will remember that in our statistics, it's sigma S. Okay. This is a sigma of what? All the returns over N. That is the number of what? Yes. So, please, I hope you are following. Today, I'm not writing the calculation just there. So return, you can see, this is in decimals, but I'm changing it. This is in percentile, but I'm changing it to decimals. So some 10% is 0.1, 20% is 0.2 plus 0.2. There's a sigma, so plus summation. 15% plus 0.15. There's a -5%, that's a minus 0.05. Then 7%, that is what? 0.07. Okay. All over what? 5. So all over 5. When we sum all this divided by 5, this is what we are getting in decimals. Okay. But returns are normally given in percentile. So we convert it to what? Percentile, which is 9.4%. Okay. Now know that the higher the mean, the higher what? The returns. Okay. Are we okay? Now let's go to risk. Risk, like I said, the unfavorable condition surrounding investment. Variance is how the return is dispersed around the mean. And the higher the dispersion, the higher the possibility that it will deviate. So the higher the possibility that you might not meet the returns you are expecting. Okay, so there's the formula. Sigma of the returns we had in the question, we have in the question, one by one like this. Okay, minus the mean that we just calculated, all squared over N minus 1. Okay, so the first return we had was 0.1 minus the mean. The answer we got 0.094 squared plus 0.2 because it was 20% minus 0.094 squared plus 0.15 minus 0.094 squared plus into bracket minus because it's negative. Okay, negative 0.05 minus 0.092 squared plus 0.07 minus 0.094 squared. Okay, all over what? The number minus 1. So total is what? It was 5 years. So 5 minus 1. Okay. All right. So when we did it, when you do all this, okay, for those who are not good in maths, the next step will be 0.1 minus 0.292. What you get, you square it. You do that for all of them, okay? Then you divide it, which will be 5 minus 1, which will be 4. You divide it by it. And we are going to arrive at this. Okay. So the higher the variance, the higher the what? The risk. Okay. So that's it. Now to get standard deviation, you just have to root the variance. So you can see that I've rooted the variance. The variance, the symbol is this squared. Okay. So I root it, then I put the answer in it. I got 0.094. Okay. Standard deviation can be in percentile, but variance is not cannot be presented in percentile. Now to go further in assessing the variance, we can do coefficient of variance. And coefficient of variance is standard deviation over what? rate. So standard deviation we got here over the rate is equals to what? 1. Okay. So this means for each of the return match with 1 unit of race. So for every return you get, there is what? 1 unit of what? Race. Okay. So that is it. Any question? Please, if you are not following, you say it. Okay. Any question? Okay. Now, please, someone has unmuted Matilda. Okay. Now, single investment analysis using probability data. I told you there are 2 data we can use in assessing single investment, or sorry, to assess investment based on rates and return. And we have done the historical data one. Now, we are coming to probability. So this example of what? A question, okay? Example of question said, when you do not believe history will repeat itself, then you have to use probability data. Okay, so there are instances you believe that history will not repeat itself. If history is not going to repeat itself, then there is no need using historical data to do your analysis. Okay, but probability data is here. Okay, this is the table illustration 2. We have weak economy, moderate, and strong economy. And in weak economy, we have probability of 0.2, 0.5, and 0.3. These are index ones, so probability should add up to 1. Okay, if it's a percentage, you have add up to 100. Then these are the returns. Okay, now let's look at the formula. A sigma return times probability. Okay, so it means summation of probability times what return for each of them. So you can see that I've broken the formula down to return 1 times probability 1 plus return 2 times probability 2 plus return 3 plus probability 3. So that's it. Where is my return 1? This is return 1, negative 0.08. Times what? Probability 1. Probability 1, there's it. Plus 0.10 return, rate of return. Okay, times the probability, the second probability, that's it. Okay, then return 3 is 0.2, then probability is 0.3. So that's it. All right. So at the end of the day, this is what we are getting. Okay, we got this, and since it's return and it's best stated in decimals, we convert it to what? Decimals. Are we okay? Now let's go to how to calculate variance. This is how we calculate variance when you're using probability data. A sigma rate, the individual rate minus the what? The returns we got, raise the power 2 times what? Probability. Okay. Okay. So the first, when you go back to this, you see that these are the rates of returns. Okay. These are the probabilities. Okay. So you put it in your mind. When the first rate return minus the return that we had, the return calculated we had squared times what? The first probability plus the second return minus the one we calculated, the mean we calculated, squared times the probability. The third return minus the mean we calculated squared times the probability. Okay, so when you solve all these, so mathematically you solve the one in bracket first, then come and multiply it. So this minus this, raise the power this, what you get, you multiply it by the what? The probability. You do for all, then this what you're going to get 0.0094. Okay. All right. So standard deviation, the same thing, you root it. And I said standard deviation can be written in decimals. Coefficient or covariance is the same standard deviation over what? Rate of return. So you do it and get 1.3. And this says for each of the units of return is matched by 1.03 units of what? Risk. Okay. So this is what we have for single investment. Okay. I'm going to upload this on the YouTube and you are going to learn more. So I'm going to pause, then I will talk a little about, because I just want this portion to be there. Okay, so stop. Okay, stop.